Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about traditional markets such as the Nasdaq and the S&P 500 through the lens of the most recent jobs report and also through the lens of inflation and the US dollar currency index. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the Into the Equityverse Telegram channel, which you can find a link to in the description below. Let's go ahead and jump in. So today, we got a new U.S. jobs report where we added 528,000 jobs, I believe, last month, which is actually coming in a lot hotter than expected. Now, you might wonder, why is the market down today? Well, first of all, the simplest answer to that is not because of anything necessarily going on in the world, but just because it is a random walk, sort of akin to, again, geometric Brownian motion. We can, of course, always try to find reasons why the market is doing something. But that's probably just the most likely reason. It's just simply a random walk. But beyond that, I think one of the things to consider with a strong jobs report by the United States is that it actually gives the Fed more wiggle room, right, in order to tighten. The Fed doesn't really have an incentive when inflation is high to pivot if they can consistently point towards a strong job market or a very tight job market where unemployment is relatively low. I think that in a phase or in a period of high inflation, good economic data can actually have sort of like the inverse effect on general market sentiment. And again, the reason is because when you're looking at inflation, what you're really looking for is you're looking for reasons for the Fed to pivot back to being more accommodating, going back to, say, quantitative easing instead of a rate hiking cycle. But good economic data, even when we're in inflation, what it means is that we simply do not have as much reason or justification to pivot quite this soon. The reason we don't necessarily have that much reason is because inflation is high. All things considered, if inflation were a lot lower at 2%, I think we would just be more or less in our normal, overall bull market for the stock market, where it just sort of slowly goes higher. Everything looks good. Jobs are continuing to be created. And we are continuing to expand United States GDP. But unfortunately, over the last 2 quarters, we have not seen GDP expand. We've seen it contract, which by a lot of technical definitions would put us in a recession. Now, I think a lot of the reasons why you'll see some economists point to the idea that we're not in a recession, or politicians for that matter, is perhaps to save face, but also they'll look at things like U.S. unemployment. And we can go look at U.S. unemployment right now, just so we can make sure we can compare all these things. So here's the unemployment rate. Let me switch this here, you can see that it's really low, right? The unemployment rate is incredibly low. It's basically as low as it was just before the pandemic. And so as long as the Fed can just point towards data like this, then it doesn't matter, right? As long as inflation stays high, they can keep raising rates, okay? Now, the thing is back in 2008, once the recession really started to get underway, you can see that unemployment didn't peak until October of 2009, right? October of 2009. And it moved up relatively quickly. What we're going to do is we're going to actually overlay the S&P 500 onto this chart. Let me switch this to a new scale so it makes a little bit more sense. So if you look at the unemployment rate, you can see that it actually peaked after the S&P bottomed. Okay, so again, unemployment right here peaked after the S&P 500 bottomed. Okay, unemployment here is still not going up, but we know that layoffs have really started, right? Layoffs have started. There can be some, of course, the data. You can always sort of have a short-term change in what you think it might be. But here you can see that the S&P bottomed well before inflation peaked if you go back to the recession back in 2008. Now, what's interesting, again, is that unemployment has not started going higher. What this tells me, even as a potentially ignorant and naive investor, is that the Fed does not have to pivot right now. I know a lot of people keep saying that they're going to break something, and eventually they might, But right now, with a relatively strong economy, or a strong jobs market, not a strong economy, with a relatively strong jobs market and low unemployment rate, I don't think we can say that the Fed is about to pivot. Now, one of the things that I think is worth talking about is really going and looking at inflation a bit closer, okay? Because inflation can stay elevated longer than a lot of people think it can. If you go back to the 70s, you can see it really started to go up in 1972, and it didn't really peak until late 1974. If you take a measured move from this sort of local bottom right here in the summer of 72 to the peak here in late 74, early 75, you can see it was about 30 months this is about 30 months or so. I mean, if I can just switch this to a monthly chart, it should basically look the same, but because we only get this data every month. But you can see that this was over approximately 30 months. If you take where we currently have been coming from this most recent low here, it's been going up for about 24 months or so. So another 6 months would actually put us out into 2023. That's just something to consider. Again, nothing is a sure thing in markets, but just to say, you know what, we can have inflation here for a while. Furthermore, even if inflation is going to start coming down, let's say in 2023 in a more sustained way, it doesn't mean that it will go all the way back down. It might come down for a while and then just go right back up, right? Like it might come down, maybe to 3 or 4% and then just go right back up. And then we could just be looking at an inflationary decade like we saw in the 40s and like we saw in the 70s. One potential way that I think we could imagine this sort of playing out is that by the time inflation really starts to come down in a more compelling manner, a lot of people are going to be very much disgruntled with the Fed and whatnot and raising interest rates, that at some point they might feel extremely compelled to start the pivot back to quantitative easing, not because inflation's at 2%, but maybe inflation will be at, say, 4 or 5%. And they can say, well, you know what, inflation's back at 4 or 5%. We can go ahead and turn the money printer back on. But perhaps they'll do it too soon, and it'll just send us into another period of high inflation. One of the interesting things, though, when thinking about high inflation, if you compare this to the S&P 500, one of the things that I think is worth looking at, in fact, is that, and let me switch this to a log scale, is that the S&P tends to bottom when inflation peaks, okay? So if you go back to, say, the 40s and you see that first peak in inflation, that's where the S&P bottomed. If you go to the 70s and look at inflation, that's also where the S&P bottomed, where inflation peaked on that first peak, right? That first peak is where the S&P bottomed here in the 40s, and then again here in the 70s. What's interesting, though, is there was a second peak that came later in that decade, okay? So we had a peak in the early 40s. We also had a peak in inflation in the late 40s. We had a peak in inflation in the early 70s. We also had another peak in right around early 1980. What's interesting about this is that the S&P bottomed, not adjusted for inflation, of course, but it bottomed during the first peak in inflation, not the second. So by the time you got to the second, the bottom was already in, and the S&P was already moving back higher. Now, if you were to account for inflation, you would actually get a slightly different story when you actually adjust it for inflation. But in terms of just looking at where things are, just on like a nominal basis, you could point to the idea that the S&P actually bottomed when inflation had its first peak. And so I think what a lot of people are looking for right now is this the peak for inflation? And if it is that going to mark the bottom for the S&P 500? I don't know. I mean, I think this is one of those things that everyone's going to continue to spend every single month discussing whether it's the peak or not. And for the entirety of this year, I've heard people call out the peak for inflation basically every single month. So far, they've been wrong, and we'll see if they're going to be wrong again this coming month. But the thing is once it does peak and starts coming back down, we actually need to see it come down in a sustained way before the Fed will pivot. Okay, so that's where I think we currently are with regards to inflation. We get new inflation data, in fact, next week. I believe it's August 10th, next Wednesday is when we're actually going to get new inflation data. We get new CPI readings that are going to come out. Now, the Fed, though, is not going to have another meeting until September. So because the Fed doesn't have a meeting until September, market participants will continue to have to speculate on what exactly the Fed is going to do. My guess is that if it comes in a lot hotter than 9.1%, markets will likely not respond in a good way to something like that, because it shows that inflation is not yet coming back down. If it's around the same level, around 9%, then I could see it honestly going either way. And if it's well below 9%, like if it comes in at 8% or 8.5% or something, I could see markets liking that news, right? But I think the problem right now is that a lot of people are sort of assuming that the Fed will immediately pivot just because markets are down and people are somewhat upset. But unfortunately, I think that seeing a lot of jobs being created to the tune of 528,000, which is a lot hotter than expected, I think that's probably just going to continue to contribute to inflation, even if it doesn't necessarily go up on a year-to-year basis this month. Okay, so some other things I think to look out for with regards to inflation that are a little bit more optimistic are things like oil, which, oil has come down a little bit recently. So oil is this white. Sorry, let me go ahead and remove the S&P. So oil, let me get actually the candles here. Switch back to a normal chart. So you can see oil has actually been coming down a lot recently, which is a good thing for inflation. Obviously, that's one of the things that make up inflation. But you also have other things, right? You have real estate, you have food. Now, real estate does look like it's turning over a little bit, but remember, we're not comparing it to where it was last month. We're comparing it to where it was a year ago. So that's something that I think people really need to remind themselves of. Consider all the growth in real estate that happened over the last year. Where were we a year ago when making this sort of comparison year over year? And again, I think it'll be interesting to see where oil heads as we go into the winter as well. And also, I think there is some fears that food prices are going to go back up as we get into the winter as well. So we'll have to see ultimately how that plays out. Now, to go back to sort of go to the last main topic that I wanted to discuss before getting actually into the chart of the Nasdaq and the S&P, I want to talk a little bit about the US dollar currency index. And this is something that it's basically a wrecking ball. When it's going up like this, when the US dollar currency index is just in this parabolic rally, we know that risk assets just tend to get sold off. Okay. And that's more or less what we've been seeing happen for quite a few months now. And this rally by the dollar has had a local top at least at around 109. It's currently pulled all the way back to 105 or so, with the current bounce back up to 106, 107. If you actually go look on an hourly basis to when the U.S. jobs report came out, you can see that the U.S. dollar currency index spiked. And I think the reason for the spike is because people are treating good economic news as bad, because it means that the Fed does not have to yet pivot. And so I think that's sort of what you're seeing on the US dollar currency index. Note that if the US dollar currency index were to have a more major pullback, that would be really great for risk assets. Okay, so I'm really watching this one closely to see, okay, what is it going to do? Now, if you go over to the Nasdaq, I mean, you can actually see a fairly simple trend line here if you just sort of draw a trend line from each of these major peaks and you just sort of connect the dots. I think the question with tech stocks is this just another lower high, or can we break out and go on some type of new path? Okay, I mean, right now you can see that if you sort of connect the dots, we could inch a little bit higher and still arguably underneath this this line, but this is something that I think a lot of people are watching relatively closely to say, you know what, is this just another lower high? Are markets reacting to a potential Fed pivot before they actually have reason to? I know the Fed was slightly more dovish in their most recent meeting, or at least that's how a lot of people took it. What happens if inflation comes in at 9.4% next month, right? What happens if that happens? I mean, I think people might be pricing it in too soon. On the other hand, if inflation comes down a lot next month, then the people that take the risk here, could easily be rewarded, right? If they took the risk and it paid off. It's just about whether you want to take the risk or not. But again, this is where the Nasdaq currently sits. I think some other things that are useful when looking at the Nasdaq, besides just imaginary trend lines that arguably are made to be broken, look at things like that 200-day moving average, which is, that's where we got rejected off of back over here. You can see the 200-day more or less actually corresponded with this trend line that's now been created at around just over 15,000. Now this arbitrary trend line corresponds to maybe around 13.4 or so. We're currently at 13.1. whereas the 200-day is still all the way up at 14K. So if we break through this, I'm looking towards that 200-day to see if that'll also fall. I do think a lot of people are sort of in the market half, they have like 1 foot in, 1 foot out, because they don't want to necessarily miss things if the market continues to rally, but they also want to be able to have some cash on hand in case we just get another leg down if the Fed continues to remain hawkish than a lot of people think. So I do think that's more or less currently where we are. If we sort of wrap it up and look at the S&P, you can see the trend line doesn't actually match the same way. If you draw a trend line on the S&P, to sort of see where that is, you could say that it would actually have quite a bit more room to rally before hitting any type of an imaginary trend line. It could go all the way up to say 43 or 4,400. Right now, it's actually around 4,100. Which, interestingly, here it would actually correspond to the 200-day moving average, but over here it didn't. So it's sort of reversed on the interpretation of that with the Nasdaq and the S&P 500. So I do think that we have the inflation data next week. I imagine markets are going to be all over the place until then, and then we're then going to have about 1 more month until we have another Fed meeting. So after the report next week. So then I do think, depending on where the numbers are next week, we'll have to come back and talk about what they are, and then sort of try to speculate on what will the Fed do. Will they raise 25 basis points or 50? Or if inflation data comes in just as hot as it was last month, could they continue on with 75 basis points or even 100 basis points rate hike? Those are, I think, the big questions that need answering. Obviously, we need to wait another week to see where inflation data comes in. If you guys like the content, remember to subscribe to the channel, give the video a thumbs up. We also have premium at intothecryptoverse.com. Obviously, we mostly talk about cryptocurrency, but occasionally I talk about the stock market and other macroeconomic things. So make sure you check it out, intothecryptoverse.com. That'll wrap it up for the video. I'll see you guys next time. Bye.